You know, personally, we get the day, and the only reason we get the day is because find out what's kind of going on, because a lot of times when somebody will, I think you referenced the article in the day.
Yeah.
You know, I may have to miss it at that time, but there's not a lot of, most people won't go to the, town website. And, dig down and find out what's been changed, what hasn't. So it's a tough situation. But, the meetings are right there and easy to access,
Did I make it to the right place? Is this the pension committee?
It sure is.
Oh, fantastic. Hi.
Hey.
Kate Peasy, I'm filling in for Chris.
Yep.
Oh,
Kate.
okay.
Hi, good morning.
Morning.
Oh,
Oh, no, we see Chris's face on the TV. You got somebody in person. That's even better.
There you go.
Morning, Sharon.
Good
Sharon's on. Sharon's.
Yeah.
Morning, John. I'd
Oh,
unmute.
Marcia, you're on cruise. I see water behind you. I mean,
I wish I was.
Did anyone, I didn't, I went, Christie, oh, she had a good start, so,
I think she was going to start this. So
She had to go up to her desk.
yeah.
Obviously she did, so.
We don't have anybody else.
Yeah, I'm here, John.
Oh, who's that, Dan?
Yes.
So what if I sit over there? Is
Absolutely.
that okay? I felt like you were lonely over there.
That's right, then you can-
My back to
you can see more
It's
people
okay. Okay.
Okay,
Yeah, I'll accept on it.
it's a little bit better view too, You could just- especially when they have the sprinklers on and they hit the window, you think. Okay, who are we missing? Not missing anyone. No,
I don't think so.
Dan and. Okay, all right, I will call this March 15th Retirement Board meeting to order, and we'll start with presentation by Kate. Kate,
Good morning, Kate. Yes, Kate
Good
Peasy.
morning.
Yes,
what's your last name?
Peasy, P-I-Z-Z-I. Okay, so hopefully you all have the material that Chris has sent. I'll start with just a quick update on performance as of the end of February, and then we'll get into the supplemental materials, which really focus on some new asset classes that I know Chris had spoken about last time you met together, but we'll be recommending some allocations and some managers there. So first, if you, on the February 2022 report, if you go to that first page over asset class performance, just briefly, you can see here kind of across the board negative performance. Really no place to hide in February. That essentially was the case in January and continues to be the case in March. We have some outliers to that, which I'll speak about briefly. But first, the collection of bars to the left-hand side that are dark blue represent fixed income markets. The bars represent year-to-date returns. The circles represent the monthly returns. So just a few notables and the allocations that that you have in the portfolio, I'll point out. U.S. core bonds, you'll see year-to-date down 3.2%. About half of that coming in January, half of that coming in February. If you add in March, this first half of March year-to-date, bonds actually are down 5.7%, really representative of the significant increase that we've seen in interest rates since the beginning of the year, where it was not much really had changed from a Federal Reserve perspective coming into the new year, but it was almost as if investors kind of shut their eyes to the expectation for higher rates that had come out of the Federal Reserve until that flip of the calendar to 2022. and kind of all bets were off at that point. If you go to the center of the slide, the gray bars represent global equity markets. You can see it's been a tough sledding across the board, with actually international markets holding up better than domestic markets. Now, if you fast forward to the first half of March, we're kind of equally down across the board, around 13% down across each one of these sectors. The highlight in the month of February was really surprisingly in small caps. Small caps, US small caps, tend to be more insulated from a lot of the pressures that have been happening internationally. So that actually helped during February. But really, February started quite, I'd say, positively, on a positive note, with some strong economic numbers. But then as the war in Russia and the invasion of Ukraine really started becoming a reality over a threat, and then really digressed into full-on war, we saw that impact across equities, most notably within international equities and in emerging markets. Now, the highlight, I'll say, you can see the one significantly positive bar has been on the commodity side. Probably not surprising, as we're seeing it at the gas pumps too, but the rise in oil prices has sent commodity investors really doing quite well, up 15.6% year to date. Fast forward through yesterday, up 25% year to date. Now, today, there's a significant pullback in oil prices, but that market certainly has been very fickle. That being said, the real asset allocation, you can see there's that second blue bar is a broad real asset component. That's really kind of what we are proposing to add to the portfolio to help diversify away from fixed income and global equities, and be able to help add some protection against inflation as we move forward. Any questions on the overall market? Okay. So with that, I'm going to actually just jump into the portfolio. So I am on page 6 of the slide deck, and you'll see a portfolio dashboard. Now, this is actually a new slide. So we have revamped our reports to make them hopefully a little bit more user-friendly, a little fresher formatting. But this is a page that I really like that we've added. It's really that your one-stop shop for everything that's gone on in the portfolio, showing both performance and allocation at that higher portfolio level. So you'll see in the top left-hand corner the historical performance for the portfolio as well as the benchmark. The portfolio is the dark blue bars. The benchmark are the blue bars. Over the 1 month, we have had a bit of a tough go in February. What has been the headwind for the month has been some underperformance from some of the active managers, and that actually bled through in January as well. But if you look out longer, those actually have been contributors to that longer term performance. It's that those active managers that we have across global equity markets. If you look at the upper right-hand side, you'll see that performance translated into dollars, where we're showing for the 1 month, for the month of February, where we started the month at 30.8 million. About $200,000 came out for benefit payments, and then the net investment losses on the month were about $700,000. So finishing February at just shy of $30 million. On the bottom of the slide, lower left, you'll see the allocation for the portfolio, in 36.5% fixed income. This is really core fixed income, similar to that allocation that I showed you on the last page for the broad asset class. And then that's rounded out with US and international equities. What we are recommending is that we add to the fixed income, not adding to the fixed income allocation, but taking a sliver of that and allocating towards a more flexible fixed income mandate, and then taking some away from US domestic equities and allocating towards real assets.
Okay, Chris talked about that last time, and I think he was he planning to make a recommendation today?
Yes, I have those, yeah, for you. In the lower right-hand side, you'll see the allocations, but also the differences versus the benchmark. So you can see where the overweights and underweights are within the portfolio. And you can see we're really pretty well on top of benchmark. On the domestic equity side, a little overweight there. We're actually looking at pulling some of that into that real asset allocation. I could talk about that in a little bit more detail as we get into that recommendation too. Any questions on the performance or even on this dashboard slide?
Basically, there's no place to hide.
It's tough to find a place to hide. Yes, yes. Unfortunately, the sad truth, yes.
Treasuries.
Yeah,
Treasuries have even been underperforming pretty significantly as well. But that being said, we do think fixed income still has a place in a portfolio as we are long-term investors, but it is getting much more challenging. Okay. In the interest of time, I'd like to just move over to the recommendations, if that's okay. But I wanted to just make sure to address any questions on any individual managers that you may have. The one manager I will comment on that I did want to comment on is Invesco Developing Markets. That's the emerging market manager. On slide 10, you'll see that manager performance. Also to the report, you'll notice we've added both the market value of assets as well as the percentage to these performance pages. So not only can you see how the manager has performed, but you can see how much of that represents of the portfolio, which I think is incredibly helpful as well. So as you may be aware, Invesco is more of a growth-oriented manager. They tend to be pretty concentrated as really we hope an active manager has high conviction of the stocks that they're selecting. But they've had a 7.5% allocation to Russia, which has been a significant headwind for performance for this year. That was across 3 names. So one of those names actually represented almost 4.5% of the portfolio. Now with really all Russian stocks being marked to essentially zero, the Russian stock market continues to be closed. So although they're holding those pieces, they did divest out of one piece. They're holding those pieces. They are effectively marked as zero, and that's really what has driven that performance negative versus underperforming versus the benchmark for this year. As I mentioned, there was kind of one Russian piece that really contributed half of the underperformance just for the month of February. Any questions at that point?
so were you, I mean, other than pointing that out to us, were you, no, there's no recommendation?
There's continued to be unmaintained. There's no recommendation to make a change at this time, but I did want to point that out that there was some exposure there.
Hey, excuse me, John, I just had one question. On that data that you're showing us, for the specific managers, is that net of fund expenses?
Yes, it is.
It is. Thank you.
Okay.
Sharon, anything?
All right, then if there are no other questions, I'll kind of change directions a bit and go to the other attachment, which is called the Ledger Portfolio Review FIRA March 2022. And I know during the last meeting, Chris discussed the asset allocation work that we've done, and one of the thoughts coming out of there was to really twofold. One, introduce a flexible fixed income manager, and also, especially in light of the higher inflationary prints, adding a broad asset allocation. So on page 4, you'll see the executive summary. You know, our expectation coming into this year was for heightened volatility and greater dispersion among the asset classes. One, we think active managers, it's an environment where active managers can outperform over that medium term. But also in light of that added volatility, really needing to make sure that one, we have the ballast in the portfolio for fixed income, but also that we are looking towards other asset classes beyond your kind of traditional global equities and fixed income. So first, starting with fixed income. I think fixed income continues to be a very challenging environment. We really felt that way through all of 2021. However, rates really didn't move significantly until the later half of 2021, where we saw a pretty large move higher on the short end of rates, but long rates really held relatively low. That being said, as I mentioned, kind of the turn of the calendar really changed the dynamic where the Federal Reserve did come out and kind of confirm their tightening or their desire to start to stop buying bonds in the open market and start raising interest rates, especially in light of their kind of two-pronged guideposts there for full employment and price inflation control. So being that the job market is incredibly strong, we continue to have more jobs than employers are able to get filled, the inflation really becomes top of mind here. One of the important allocations that we think will help mitigate some of the pressures from rising rates would be to be able to utilize a dynamic bond allocation. So a dynamic bond manager where really has the flexibility to use all of the levers within the fixed income market, most notably duration. So the manager that we're recommending is BlackRock Strategic Income Opportunities Fund. That lever of duration, this fund is actually able to go negative duration to +7 duration. So actually, yeah, kind of counterintuitive of what you would think would be, would make sense, but they're able to go, their mandate allows them from a -2 duration to a +7 duration. They generally stay between 0 and 3-year duration. And this is really in an effort to try to mitigate what we see as the top risk within fixed income market, which is interest rate risk. Something that really has not been the case for the last 35 years here. What we are recommending is to reduce the Vanguard Bond Index Fund by 8.5% and reallocating that to BlackRock Strategic Income Allocation, Strategic Income Opportunities Fund. And as it's kind of underlined here, the overall allocation to fixed income is not changing. It's really within kind of under the hood of fixed income.
So why you're taking it? I mean, that's what he said. Chris said he was going to take it out of the other, take it to 3 with terms about 6 years. He was going to put it, why you take it all out of one? Just out of curiosity.
So in this market of, I would say a far more challenging fixed income market, I think this is an area where active managers really have been able to prove their worth really in almost any market. So taking it out of that passive mandate and keeping those active managers where we think have the ability to bob and weave more effectively than just that passive.
So the other two, I think there were 3. The other 2
There
are active.
Yes, so you have Metropolitan West as well as PGIM Total Return. Both active managers do things a little bit differently from each other. That's why we like having those 2 together, but maintaining those and just reducing that Vanguard allocation.
Chris mentioned trying to get the term down to about a year.
Yeah.
That's where we'll end up.
So-
You mentioned 0 to 3, but.
Yeah, so it's the duration right now in your fixed income portfolio is about 6.5 years. With this change, the duration is about 5.7 years. So the duration of the BlackRock fund is about 1.5 years. And they tend to, they are pretty tactical with their duration. So as rates have moved significantly higher, yesterday was a huge move higher. They tend to move that duration pretty quickly, but that's also what we're hoping that they will do.
Has their past performance outperformed the benchmark?
Yeah, so I can jump right there and show you some of that information. If you jump all the way down to, let's see, 32, page 32. So what we're really benchmarking here against is the Barclays aggregate. That's essentially the S&P 500 of the bond market. And so now that's not what BlackRock is kind of agnostic to a benchmark. They want to drive total return in any market through utilizing all of those levers. But what we're showing here across the top is the annual returns. This is as of year end for the Barclays aggregate, as well as for the BlackRock Strategic Income Opportunities Fund over different time periods. So the first set are trailing returns, the next set are calendar returns, and then the volatility, how much kind of risk you're taking to get those returns. Now, I'd say that the risk is a different type of risk in the BlackRock Strategic Income Opportunities than in the aggregate, where the aggregate, the risk is really in interest rate risk. BlackRock introduces some credit risk as well, again, utilizing those levers in order to drive those returns. But you can see just the past 2021 in a rate environment that was pretty challenging and also pretty volatile, the ag was down 1.5%. This strategy was actually up 1%. Now, I think actually what's really interesting is when you look at the calendar years. So in years where the aggregate bond index has done well, this strategy has also held up quite well. So that's what we're looking for too. So not only are we looking for protection in an increasing interest rate environment, but also to kind of hold its own in a more moderate environment. And you can see that in those years, it really has done its job in holding its own and even being able to contribute to some outperformance there. The other slide page that I just want to point out is actually the next page, which I think is really helpful. It's the very last at the top, the very far right 3 columns, max drawdowns over the last 10 years. So at the point where the aggregate was at its worst drawdown period, what did this strategy do? Did it protect in an environment where bonds had a very tough go? And 2013 was the time of taper tantrum, if you remember that time frame, down 3.7% for the ag, and clearly protected, down just shy of 2% for the BlackRock strategy. In 2020, again, this is where rates increased substantially from August 2020, kind of coming out of the pandemic through first quarter 2021. The ag was down 3.6. This strategy returned 5.4%. So pretty good. And then similar in 2016, that was some high yield issues and a rate piece as well. So that's really why we like this strategy. It drives returns. It seeks to drive returns through a lot of different ways, through credit, through sector allocation, and through duration is kind of their main levers to be able to drive those returns in a challenging fixed income market.
It seems like a good strategy because I mean, there's a good upside. It does pretty well when it's up and it does well when it's down. Probably should have been maybe looking at that even before.
So it's been, I would say 2021 was a year where the first quarter bonds really sold off hard. I would say the rest of the year, the ag did okay for the rest of the year, but certainly I think it makes sense now to get into.
And again, these returns are net fund expenses.
They are all net of fees, yes. So if you, go ahead. If you just back up a couple pages to page 20, you'll see that recommendation kind of spelled out here, where at the top of the page, you'll see in the current allocation, the 3 fixed income managers, Vanguard total bond return. This is that low cost passive approach. And then your active managers, MetWest and PGIM total return bond. And then adding BlackRock Strategic Income Opportunities Fund in that last column. So taking 5% out of that 13.5% allocation from Vanguard, so resulting in an 8.5% allocation to Vanguard, and moving that into BlackRock Strategic Income Opportunities. So maintaining that allocation to fixed income, as I mentioned, the duration or that interest rate risk of the fixed income sleeve comes down about 0.7 years.
Is that enough?
We think that one, it's enough in that if you were to tell me rates were definitely going to go up, I'd say, you know, let's go much shorter than that. But we still need that ballast in that in the portfolio, and keeping that strategic long-term allocation in mind, that's meeting your expected return to support the pension liabilities.
Sure seems like interest rates are gonna go up.
So, yeah, we wouldn't be recommending this if we thought that rates were going lower over the long term. I think that there's enough challenges in front of us that we feel like this is an adequate allocation.
And the choice was the Vanguard fund only because that was one of the index funds. That's not touch the active funds.
It is not, right. Let the active managers still be able to kind of flex their active managers there. But utilize BlackRock Strategic Income Opportunities Fund as that ultimate flexibility. Now, certainly, I mean, that's the BlackRock fund, we would be comfortable with probably up to 10% allocation, but much more than that, then you're really introducing much more credit risk to the portfolio than we would want at this point, especially in, again, a fixed income allocation where we do want to have that ballast in a portfolio over that long term. But we felt like 5% is kind of the right level at this time. Any questions or concerns?
Explaining negative duration.
Yes. Yeah. So negative duration is essentially kind of a short on the fixed income market. So what BlackRock will do is use treasury futures or short treasury futures to be able to gain the return, kind of the opposite return of a duration play. So someone has the other side of that who is kind of betting on rates going down. They will then kind of pay the return to the fund for taking the other side of that trade. So effectively a negative duration. I know it's kind of difficult to there's not a bond that's issued at negative duration, I'll say. It's kind of a derivative product. Yeah, where they can get that negative duration. Again, they use that pretty minimally. Their portfolio duration overall is generally 0 to 3 years. Sure.
Yeah, I just had a question. So that the dollar amount to that then would be somewhere in the order of about $1.5 million, give or take.
Yep, that's almost exactly it.
And you guys would propose that we pretty much do that in one shot, right? Not a phased purchase approach, right?
Correct. Yes.
Okay.
We need to ultimately vote on that.
I think we would, yeah.
We can do it at the end, but
Dan, where are you getting that? I'm looking at the,
No, I just did the math real quick, John. When I looked at how much is currently in the Vanguard fund, when I was looking at the flash report, it's about a little over 4 million. So if we're
Right,
going to
yeah.
go from if we're going to go from 13.5 down to, what do we say, 8.5%, that would equate to about $1.5 million, I guess, would put into BlackRock again, roughly.
Right.
Gotcha,
right.
okay, I was just taking half, but, okay,
That 5% of the
Got it.
overall portfolio. yeah,
gotcha,
that we're
Yep.
doing.
okay. All right,
Any other questions before we move into real assets?
Nope, nope.
Okay. All right, so I believe that Chris talked to you a little bit more detail about real assets, so I won't go through the details all that much, but I do think page 25 is a really interesting slide and really helpful supporting that move to real assets. Real assets, I think, really, provides multiple benefits, but one being inflation protection, the other being diversification. And the last bullet, I think, on this slide 25 really says it well, that it's difficult to project. Even the Federal Reserve, who arguably has the most direct impact on inflation, seems to consistently get it wrong. But not only to project, but also to time it. And that's why we want to introduce a strategic allocation to real assets. The bottom of the page is interesting. It shows some of the major asset classes within the real asset allocation. Then it also shows stocks and bonds. So stocks and bonds being the first two bars in each of those sections, and then the other bars representing the real asset asset classes. So in 80% of the time, the inflationary environment is either stable or increasing. Really across the board, the real asset exposure tends to be a contributor to performance over time rather than a detractor. You'll see in the minority of the time, 18% looking back over the long term, we've been in an inflationary environment, and you can see that energy stocks, commodities have underperformed in that deflationary environment or a falling inflationary environment. Not surprising to hear, but I think what's probably more surprising is how consistently positive these asset classes have been, even in stable inflationary environments. So what we're recommending on page 27 is an allocation to broad real assets. So not to any one asset class, but hire a manager that has that expertise to be able to find where the value is and adjust the portfolio accordingly. So who we're recommending is DWS, REIT Real Asset Fund. We're recommending an allocation of 5% and taking that from domestic equities. Now, under the manager due diligence, where we were before talking about the bond fund, if you go to page 36, well, there's a lot of tiny words here, so I won't ask you to read those words, but I'll give you a bit of a synopsis about this manager. One, the way that they manage the real asset fund, they are allocated to global real estate, infrastructure, commodities, natural resources, and TIPS. So they really represent much of those categories that we were just looking at, really all under one roof. I would say what they do and why we really like them is that they tend to be much more tactical, which we think is important in this environment. And they have a really unique approach to the way that they construct their portfolio, and that they use this quadrant model is what they call it, which is evaluates both growth expectations and inflationary environments to structure portfolios they feel will outperform in each of those different quadrants. So increasing growth, increasing inflation, increasing growth, decreasing inflation, and likewise. And then kind of weight those different portfolios based on where their expectations are today. And that's how they drive their tactical allocations. So again, I think rather unique, a differentiator, and has proven to do pretty well, hold up pretty well. Currently, they're underweight real estate, global real estate, they're overweight infrastructure. And again, they have about a 10% strategic allocation to TIPS as well. So they do have a little bit of that ballast in there. On their commodity side, and actually across the board, they are kind of gaining this exposure through equity markets. So natural resource equities, REITs. And that's really why we are taking from the US exposure and funding that 5% allocation there. On the next couple of slides, you can see that performance. Again, this is after fees and how that compares to the S&P real asset, the broad real asset benchmark. Now, this is an asset class, and as you might imagine, that's very difficult to benchmark and very difficult to compare managers because they do it so differently. But that being said, we do like their their focus here and that unique construct on how they think about portfolio construction.
That benchmark S&P real asset, is that a percentage real estate and a percentage natural resources and a percentage energy, or does it vary over time?
It does. It's about a third. So it has natural resources, commodities, and real estate in there. So yeah, it has those pieces in there.
Am I looking at this right, that annual returns have been for year one, 23%, 13, 16, 10, 25, 11.4?
You are looking at that correctly. Yeah. So boosting much of that return, keep in mind, REITs in 2021 were up 15%. Commodities were up 20-something%. It was an incredibly strong time for real assets. It continues to be a very strong environment for real assets, particularly on the commodity side.
So this fund has outperformed the benchmark the last 4 calendar years, 4 or 5 calendar years.
Yes, yeah, and they've been around, I think, for about 7 years. So you can see that the longer, we're not showing the 10 years. Oh, back till 2016 to NA.
Very impressive.
So again, a fund that we think is really managed well to be able to kind of be tactical in a very not only volatile environment, but an environment where the inflationary pressures are high and I'll say changing.
So you're gonna, the 5% you're gonna take out of equities, that's just gonna be kind of peppered through the equities mix.
Yes, through the US equity side.
Yeah.
And
Well, I'm sorry, just a question to follow up on that. It's 5% you said from the Vanguard fund, correct? Or were you going to split it between all of them?
I'm sorry, it's 5% from Vanguard, the S&P 500 fund.
Right, okay.
On the
So again,
US
that would
equity.
be, right, and that would be again in the order of around 1.5, 1.4, 1.5 million, it looks like about.
Yes,
So again, we're touching the index fund only.
index
Yeah,
fund only.
okay.
Mhm. The only other piece around the real asset allocation would be the IPS. So the IPS right now in the allocation table, which is an appendix to the IPS, doesn't have an allocation to real assets. So the third attachment was kind of our recommended changes to the IPS if you were to move forward with the real asset allocation. And that's at the very bottom of the IPS, again, in the appendix.
But in the IPS, we're just gonna make a change to the domestic equities. I thought we were gonna make it to the range, but look like we're making it to the max. You say we need to add another category to our IPS that takes into account.
The real asset
Real
piece.
asset
Mhm.
piece.
And taking it out of that domestic equity, the US equity. Let's see that.
That wasn't, we didn't make that recommendation in what came out, right? Yeah, okay. So that still has to be done. Okay.
Right, that's not been done, but it's included in that Word document. The IPS that was sent out on that final page on the target asset allocation, taking it out of domestic equities, the target,
Oh, yeah,
taking
there it is.
5%
Okay,
out
it
and then
was-
adding to real
It's in the
asset.
one that you sent, Don sent us yesterday, not
Okay.
in the one that was attached to the agenda. Got it, okay.
Oh, okay, sorry about that, yeah.
No, no, that's fine, that's fine. Now I see.
So just a question. So I guess the thought process is a real asset really warrants its own unique specific asset class. It's not really, it could be argued, couldn't it, that it's a little bit of a subset of the domestic equities, or no?
We would say it warrants its own asset class. Remember, it has tips in here, the treasury inflation protected securities, which are actually fixed income securities.
Fixed income, okay, okay. So it's a bit of a blend between those, so that's why you say pull it out as a separate one.
Exactly, and some of their commodities exposure is traded through the futures market too. So yes, we would support pulling that out.
Okay, and I guess I don't, and I apologize, I didn't see it. The only update I saw for March 2022 was the change to the domestic equities with a maximum weight of 50%. Is there another chart? I'm sorry, and I apologize, I'm missing that shows what the recommended min, target, and max weight is for real assets?
Yes, it sounds like you are not missing anything, but there was another version sent out yesterday.
Yeah, yesterday Don sent it.
Oh, he did. All right, let me look for that. I'm sorry.
But it is that same allocation table where the change is made.
We talked about the benchmark being the S&P real assets. Now in the appendix A, I see a different benchmark for real assets.
So the benchmark that DWS uses is the benchmark that we've included in the allocation table. So that's the benchmark that DWS benchmarks to, which has those other asset classes, those broader asset classes involved as well. But that's definitely something that I can take back to Chris if you prefer to use the more, I'd say the broader benchmark.
Yeah, because doesn't that mean they make up the benchmark and they, for which they're performing to?
Yeah, and that's something that our manager research group does focus on to make sure it's appropriate, right? How are they, giving them the yardstick for which their own performance is measured against? So if that's something that you'd like to kind of revisit, I'll bring that back to Chris for sure. Any other
Okay,
questions?
anything else? Any other questions? Dan, while we have Kate here, would you like to make the motion for this, since you seem to have the, say the magic words, and then Kate can correct us if we're.
No, I mean, I've gone through it. I think those are reasonable recommendations, so I'd make the motion that we approve both those recommendations.
Second,
Okay, can you say the words, because Christine is going to be looking for.
a bunch of
and I
words.
just-
Man, you're really
I just took the words from the, where it is, right there on slide.
It's on their package on slide 4, I guess, right?
About the BlackRock, right?
Right. Yeah, so the recommendations were made to reduce the allocation of the bond index fund to 8.5%, reallocating those funds to the BlackRock strategic income. That's on page 4 of their package. On the second bullet down on the second subset of the second bullet, and it's there in italic print. And then the second recommendation is pretty much verbatim what they have, the very last bullet on slide 4.
Okay,
Still second it.
okay, Sharon, you got that?
But,
Everybody have that on,
yeah,
Page 4,
we're
yeah.
actually specifically taking out of the Vanguard, right, 5%. More
Yes,
than, so it's specifically where we're taking it from.
yeah, and it
And adding it
does,
to the BlackRock.
Yeah.
Yeah, and I mean, you look at the other options there, Bill, like the other one would be the Touchstone, which, I mean, that was a reallocation. I think we only did probably within the last year or so. I'm not sure it makes sense to take it out of that just yet. I think we want to give that a little more runtime, maybe.
okay. Okay, any discussion on that? All in favor?
Aye.
Aye.
Opposed? Okay, very good. Great. Anything else for Kate?
So did we,
Go ahead.
did we just do both allocations in that one motion? And,
Yes.
okay.
Yeah.
So both.
So Kate, when do they typically execute something like that?
As soon as possible, as soon as feasible. So when I go back to the office, we'll have the analysts put together kind of the trade worksheet to show what these trades look like, and then we'll send it for approval and implementation.
Okay,
And the only thing you were gonna ask Chris about is the benchmark.
The benchmark, correct.
Okay.
If that benchmark changes, will you provide a revised?
Absolutely.
I suggest we leave it at S&P 500 real assets, because that's if we look at the performance charts, the charts are using the S&P 500 and not DWS. So we start with the S&P real assets benchmark as the index.
I'm comfortable with that. So if from our perspective.
I think
we
it's
do
better than,
It's a broader index.
yeah, and I think it's a better, yeah. You say in real assets, it's tough to come up with a benchmark.
It is, because they're just that the funds are so unique, but
That gives you an
I think
idea
a
how-
probably broader makes more sense then, so you can see where
Okay,
their value is.
so we can make that change if we wanted to vote on it.
And you want to restate that so Christina hears that?
So in the IPS provided to us for updated March 22nd, under real assets, we were going to put S&P 500 as the benchmark.
The S&P real asset.
Real assets. I'm
Yeah.
sorry.
Yeah.
Real assets, I'm sorry. I get it.
Right. Okay. Okay.
So we'll send that revised IPS for.
Okay. Very good. Well, if we have nothing else, thank you.
I mean,
very
just,
much.
Hey,
Oh, go ahead,
Jack, I mean, I don't think it's an issue, but just from a timing point of view, I mean, we just approved the reallocation, but we haven't approved yet the target asset allocation table. Does that pose any issues? Because we're going to make changes to the portfolio, which we've all agreed to, but the target asset allocation table is kind of lagging. I mean, I'm not sure it's more just a timing issue, or.
I think we can vote on it now. We just make that one change,
And one change.
that
Well,
one change. and then-
Yeah, I would agree with you, Bill. I mean, if we vote on it now with that one change, then it's just kind of all complete as one package.
Go ahead, Dan.
Well, then, so I'd make a motion that we approve the target asset allocation table as proposed by Chris, with the modification that the S&P 500 real asset be included as a benchmark index under the real asset category.
Second,
And just it's the S&P real asset, so it's not the S&P 500 real asset.
Yes, I'm sorry. Yeah, I missed it. Yeah, S&P real asset. I'm sorry.
Sarah, you said right.
Yes.
Okay. Sharon seconded that. Okay, any other discussion on that? Okay, all in favor?
Aye.
Aye.
I vote. Okay. All right.
Perfect.
Thanks again, Kate. Appreciate
Thank
it.
you.
Okay.
And we'll see you probably again next month.
Me or Chris, yeah.
You were great. No, I'm saying,
Changing.
Yeah.
Okay, things are changing.
thank you for your monthly, quarterly reports.
All right, thank you again.
Okay, great. Have a great day.
You too.
Thank you.
Okay, moving on here. First order of business is the meeting minutes of February 15th. I will make a motion that we approve those.
second,
Okay. You all saw those already, so your comments were provided to Christina. Was there any other comments that you saw? No? Okay, if not, all in favor?
aye.
Aye.
Okay, Don?
I'll defer to the, my section under old business.
Say again?
I'm gonna defer, I'm under old business here.
Oh, you're under old business? Okay, all right. Matt?
Yeah, the only thing I have is just to let you know that, based on a trade recommendation worksheet from Fiducient Advisors on March 1st, there was investments of 375,000 that were liquidated basically just to raise cash to pay pension payments for the next 3 months.
Got to do it.
Yeah. I mean,
How do they decide what to liquidate? So they hold some cash, but they didn't have enough, so they had to liquidate something. I
Right,
just
they
wondered-
needed to raise cash for.
I just wondered how they decide
the
to
next
what
3
to
months
liquidate.
of pension payments.
So you got a letter from them saying they did that?
There's a trade recommendation worksheet. and then we have to
Oh,
sign
okay,
off
got it,
on that.
okay. Oh, you did, so we signed
Yeah.
off on,
Correct.
so on that, they must have said what they were gonna.
Correct.
do. Okay, that's how it got. Okay,
Can you send that to us? Matt?
Okay.
Email it to us?
Yeah.
Okay, great. Okay. Ian, anything? No? Okay. Before I get into old business, I want to make a little speech. I don't know if you, and I think I sent this to you in an email, but you may have all seen the article, maybe I sent it to you, about Waterford and Waterford proclaiming that they were 100% vested with their pension plan. And yet when you looked at the numbers, you're like, wow, we're much better than that. And we don't have a pension plan anymore. So once again, I will state that the need for us to increase our payments into the pension fund, I think while it's prudent and everything else, I think when, the mayor is looking to, take us through with hopefully without raising taxes. And I know right now is a little bit of a, I still would make my case that Ledyard's fund is fine, does not need an increase. We are easily 100%. And again, and I know there's different figures, but again, the mayor stated recently that according to a report that we got, we're 100% vested in our pension plan. And we're going out for bonding now. And I'm sure if he doesn't, he should, the mayor should lead with, oh, by the way, bond people, unlike the state and probably 90% of the towns in the state, we are 100% vested and we continue to invest in that fund at this level.
I think what we decided last meeting was we were just gonna, because this was an off year, we were gonna wait until the report recommendations came out from
Right.
the actuarial.
And I will make a prediction what they will say. And it won't be, you guys are fine, don't bother to increase your
Well,
thing.
no, she was talking
But
about
anyway.
extending out, part of it because it was self-inflicted, because we were supposed to get to a goal, which is only a few years away. I can't remember what it was.
Right,
She
yeah, I
was gonna
understand.
recommend extending that, and so that was gonna, help in terms of what we have to contribute, so.
Yeah, but if you're the person holding the money, well, what do you want to do? Of course, you want to have more money, invest more money, and sure. It's always the nice thing to do. But anyway, okay, I've made my speech again. All right, moving on to old business, Don.
Yeah, quick update, excuse me, on this, on the non-vested, former employees. Originally, we sent out 36 letters. The total, Bill had asked earlier, was $30,811 of their money that's sitting in our portfolio. We distributed of that so far 11 individuals. And in that process, interestingly enough, Webster discovered that they had already paid one of the individuals whose name was Daniel Emery back in 2013 when he left. Fortunately, they were able to grab the money back. They did a stop order on the check, and so that money did not get taken out.
How much was that?
It was $9,000.
Wow.
So they took our list, which I probably should have had them do in the very beginning, and scrubbed it from those people, and determined that there was one other individual on that list, and so they've been taken off at this point. But what happened apparently was there was no, I went to this individual's personnel folder, there was nothing in this file, so Webster sent me all the documentation from when Dan Emery took his money out, and obviously he took it out back in 2013. So I just wanted to alert you that there was that issue, it's been straightened out, and they have scrubbed the rest of the list, and there are no other distributions to any of these non-vested individuals at this point. So you were aware last month or a month before that we had a number of people, I don't have the number in front of me, whose letters came back with no forwarding address.
Right.
We went through and scrubbed that, got second addresses for all but one of those individuals, and sent letters out again to those people. I'm beginning to get responses from those. And we ultimately ended up with 3 individuals from the list that at this point we have no address in which to contact them. So,
What kind of
We have one.
assets? Oh, go ahead.
oh, God, I didn't.
I mean, are these small numbers
They're
or?
relatively small numbers.
Okay.
Yeah. And I can report.
No,
that.
no, that's
all right.
She mentioned
I just-
next month.
I mean, it's tough.
Yeah, so what we have about another 11 people who have sent back the paperwork, and I'm sort of holding those to go back to Webster maybe at the end of the month. I don't want to keep sending them something every week that they got to do disbursements for. So we're getting down, we're picking through that group, but I believe that there will be at least 3 individuals who we just can't track down anymore. And so that money will then go to the state at some point. We'll issue that out to the state. Okay.
So we're saying we have another $9,000 now that's not coming out of our pension fund?
No, this is not in our pension.
What is this? What is this fund? What-
This money. all
This comes out of the
your
pension fund.
Correct.
That's $9,000 not coming out of the pension fund. Now we're 100.1%.
I guess I thought that money was held separate.
No, it's not.
It's all.
the
Yeah, it's
same.
all in the pension.
Oh,
Yeah.
all in the
It's
pension
tracked-
fund.
It's tracked by the, and that was one of the issues.
It's their money was never our money to begin with.
Correct. It's just sitting in the fund and it's been earning interest since they left, the 5% rate. And then we will take the money out of there. And I don't remember what your original question was, sorry. Was there a question?
Oh, no, I just, no, don't worry. I thought there was one person we couldn't track down last month. Now there's 3.
There are 3 that have come back with no forwarding address. Correct.
And there's, I mean, and Webster Bank will take care of sending that money to the state. It just seems weird. We have social security numbers on these people.
And that's how we track them. And the
And-
addresses that currently show for them came back as no.
Okay.
That's a good point. Yeah, the social security number.
Yep,
You
that's what
think
we
you
did. We
Social
did
security
track-
must know where they are.
Yeah.
You would think. But I mean, the question is, how much due diligence do you do before it's?
At some point, and if they're watching, they'll look at the state list at some point and see the names there.
Yeah, and if they're getting a social security check, where's that being mailed to?
Well, they're contributing to social security.
Yeah.
Okay,
Thank you.
okay, so we're a little bit more funded than I even thought. Okay. All right. Any other old business to come before us? We don't need any motions, Don, for anything there.
Can I
That's
just
just a
ask one more
report.
question on this? So there's this money that's their money that they put in, it's vested, it's in our account, but it's separate.
Yep.
We can't do anything with it. If there's a dollar value for that, and then there's this dollar value of this money that we're trying to send back to people.
Correct.
Is there a delta? In other words, there isn't, right? So we don't have any money, even if we couldn't, even if in this particular case, well, I guess in this case, 9,000, it would have taken it out twice.
Correct.
But it would have come out of that money that's it's separated from we can't touch it, we can't do anything with it, we can't use it for anything
It's
because it doesn't
tracked.
belong to us.
It has been tracked. So I get a list every year from what used to be Siegel that listed all the people who were not vested that had left. And that's the list we're working from. And unfortunately, that list contained the name of Dan Emery. So even though Siegel did the calculations and it did, the recommendation of how much to give him back in 2013, they never took him off the
Yeah,
non-vested.
I understand that, but when this is all said and done, I mean, I guess what I'm trying to get at, that money wasn't ours to do with and pay pensions with anyways, right? It was their money. It's either gonna go to them or it's gonna go to the state.
Correct.
The difference would be is if we gave out an extra $9,000, that portion of the fund that is for this vested, we might have exceeded that amount.
That's correct.
Because we
Yes.
would have taken out additional money, and that would have come out of somewhere else, probably.
Correct.
Got it, okay.
All right.
All right, then move along to new business. I make a motion to approve the retirement benefit for Rosanne Kotowski, the amount of $1,310.26 in the form of a modified cash refund effective June 1st, 2022.
second,
Okay. Any comments, questions? If not, all
Hey,
in favor?
I'm
ahead,
sorry,
Dan.
just a quick comment. Someone might want to point out to USI that the letter that they send, and it doesn't affect the calculation, but it's an error in that the first paragraph, they talk about employee contributions with and without interest. And they have the numbers there reversed. So, because it says with and without interest of 37,000 and then 62,000 respectively. Well, the one with interest would be the higher number. So it appears they do the calculation correctly, but their form letters are incorrect on that. So someone might want to point that out to them.
Okay, Don, you're gonna take care of it?
I will take it.
Okay, great. Okay, thank you, Dan.
All right, you understand what I mean on that, Don?
I see that now, yep.
Okay. I mean, it's correct on the spreadsheet, but their form letter, they have it reversed, and they've done it on all their form letters, I noticed.
Okay. Okay, all in favor?
Aye.
Aye.
I make a motion to approve USI invoice. I'm sorry, Dan, were you gonna say something?
No, I'm all set, I'm sorry.
Motion to approve USI invoice 9006371 dated 1/31/22 in the amount of $500 for the benefit calculation for Marcia Hancock.
second,
Okay, any discussion?
Yeah, the one on Marcia, John, now again, I'm sorry, but it was a $500 for the benefit calculation. And I thought when I saw the, and maybe it was changed, but when I saw their proposal way back from those guys, I thought they were going to charge us $400 for every pension calculation. Because that's what I looked at last night. And again, maybe it changed when we finally negotiated it, but in the proposal they gave us I guess it was last year when we did this, it says the above noted fees, there would be a $400 charge per pension calculation. So I guess I'm wondering why is this one 500?
Was there a change when we,
I'm not aware, but again, I didn't catch it, so I recommend you table it.
I'm not.
And again, maybe with the final negotiation, it got bumped up and I missed that and I apologize. I'm not trying to slow us down, but the latest information or the only information I had to look back on was the RFP, which said 400. And then Marcia also put together a spreadsheet for us a year ago comparing the different firms that applied. And on that spreadsheet, it also indicated $400 per pension calculation.
Okay, then,
and I don't know if, and again, I apologize. I should have taken the effort to look back. I don't know if we've already approved any at 500 or not.
okay, I looked at the January minutes. We didn't do any in January
This is their first calculation.
for this year.
Well, yes, under the new contract, and under the new contract with USI, this was actually the first calculation.
Okay, and Dan, you're saying you looked at the new contract?
Well, no, again, I looked at the RFP that they sent us. The RFP said it would be a $400 charge per pension benefit calculation. And I looked at the spreadsheet that Marcia sent us last year when she put together a summary spreadsheet that compared the different firms that were responding to the RFP. And in that spreadsheet, it also had those folks listed as $400 per calculation. So unless something was negotiated with the final contract where it was increased, I guess I'm not sure why it's 500 versus 400.
Okay, I don't think there's an urgency to pay this, is it, Don?
Table
Okay,
it.
so I'll table this.
Okay,
good idea.
thank you.
Thank you, Dan. Okay, I move to approve the retirement benefit for John Gorman in the amount of $4,879.97 in the form of a modified cash refund effective August 1st, 2022.
Second,
Okay. This is Sergeant Gorman retiring. So any questions, comments? If not, all in favor?
aye,
Aye.
Opposed? Okay, very good. Any other business?
Yes.
Go ahead.
This is in regard to calculate the request from Siegel.
Okay,
By touch base. So USI came back and asked for a table that Siegel had used to calculate the tenure certain calculation in the retirement process. And Siegel responded that they don't have a table, that they would need to spend some time creating the table, and proposed a bill, approximate expense of $904 to take care of that. I ran that back by Freddie at USI, and she thought it should have been part of the transition, but apparently USI doesn't, or excuse me, Siegel doesn't believe it should be. So, and they need the tables. USI needs the tables. They've used their efforts to create the tables. They can't get close enough to the past calculations for the 10-year certain that they're comfortable with saying that they were close enough. They're off by 0.007. And a lot of issues. So, yeah, they're actuaries, remember? So I'm asking you to authorize the expenditure of $900 for Siegel to create the tables that USI needs to complete this transition. And I would be back then if there was with a bill next month to be paid. Anybody have questions? Because
You said they don't have it, so but they know what USI is asking for?
yes, their response was, sorry, I should have forwarded these emails to you. They're calculated on an individual basis based on the participant's specific age at the retirement. So they are saying, please note that these factors are based on I don't know what that is. Assumptions, and is expected that actuaries and other users would be able to reproduce them. And as I said, USI has tried to reproduce the tables, but they're not comfortable that they're hitting close enough to use what their calculations are. So I'd be happy if anybody else who understands the actual.
I don't know, but I guess I'm wondering is after we spend this $900, if USI is going to get what they want or what they
I
need.
believe they will. I've been back and forth with Freddie, and she's comfortable that what they're proposing will get them what they need. She just thought it should have been part of the transition and not an additional charge.
Well, I'll make that motion. See, it's $900.
We're not really
Let's
paying a
calculate
bill right
that.
now, so all we're doing is saying authorizing to.
Yeah,
Sure. Yeah, do I hear a second so we can continue? Okay, now we discussed. Dan, go ahead. Did you say something, Dan? Did we lose Dan?
No, I'm still here, John. I didn't say
Okay.
anything.
Okay.
I was trying to do a quick look, and I haven't been able to find it again in the RFP. I was trying to look at what USI had said, what their expectations were that we would turn over to them through Siegel. I haven't been able to put my finger on that yet. So I was just kind of curious. Is this something that USI clearly said that they needed and as part of their proposal and Siegel failed to deliver? Or is it really just a question of a little bit of the mathematics that there's a slight disagreement?
Well, maybe USI thought they could calculate it, but now they're coming up with a delta 0.007.
Yeah, that's, I mean, I don't know. That's just, I don't.
The other option that you might have is to instruct USI to go ahead and use their calculations and Siegel for the proposal.
And use what they have.
Yeah, I guess I don't know enough on it or haven't seen enough to really understand. What's the significance of 0.0007 or whatever?
I think to be clean, maybe, we should just go ahead and do it. I don't know.
We certainly have the money in the plan.
Yeah, we saved $1,000.
Then
No,
Come
I
on,
don't know.
John, $900. I mean, that'll feel like your gas can for your lawnmower this summer.
Pretty soon.
is time of the essence on this thing? I mean, they have a product to deliver to us, right? They're
There, yes. So, I mean, unless, I guess, unless somebody chooses that between now and when we resolve this issue, somebody says, yeah, I want the 10-year certain, they wouldn't need to do the calculation at this point.
It- Hey, Don, is there something out there that USI sent that we can look at that kind of just, in somewhat layman's terms and in a very succinct manner, kind of describes what the issue is and what exactly that they need to do? Does something like that exist?
I will forward the email chain to you at some point today or tomorrow, so you can look at the email, but that sparked this whole thing.
But does that email chain kind of lay out succinctly, what the issue is and what they propose they need to do?
I believe it does. I believe it does, because I got the original email from Freddie and forwarded basically a cut and paste out of that because there were pieces I didn't want Siegel to see, or didn't need to see, sorry. So I will forward this to everybody and you can.
Okay,
read
all right.
that, so.
Then I'm going to withdraw my motion. Okay, Sharon?
No, that's fine, John.
Okay, and yeah, if there's a calculation that's needed to be done, I'll do it with the, because again, this is not calculating someone's pension benefit. This is helping to calculate,
Options for that.
Yeah, so that's one of the options. Nobody's
But-
taken up.
but when a person retires, they do the actual calculation. So they wouldn't, this is just, as something they're telling the person. Obviously, every day that boat goes by, a person's pension, or every month, person's pension changes anyways. Okay, anything else? Anyone?
Motion to adjourn.
Okay, second, we are adjourned. Thank you all.
Thank you.
Yep, bye.
Thank you.
Bye.
Sure.